Hey guys, this is Under the Hood by Cal. With global uncertainty, markets decreasing about 11% from February from just start of the conflict. We are here today to speak about what sectors to focus on, what sectors to avoid, and how to strategize moving forward for the rest of the year. Just after the conflict from February, we have seen the market drop about 11%. We have seen oil prices increasing, fluctuating almost above 100, falling down, and now back. Brent is about $85 a barrel. What the question now we have is how this is impacting the market. And we have seen these factors also weighing down corporate earnings as they come in, and we have had few coming today. The question now we have is what sectors are going to be impacted. So, Sajed,
Yes.
with all the impacts that we're seeing in the global scenario and in internal economy, what sectors do you think we should be looking at or investors should be looking at right now?
Yeah, that's an interesting question because if you look at the market is down about 11%. And when the market is down 11%, there's obviously certain sectors which are insulated to what's happening in the geopolitical situation. And also, some sectors might not be completely insulated. There might be certain sectors which are less impacted. So our focus right now would be in terms of looking at or picking your shares within these sectors. So if I am to give you a breakdown of what sectors would look good in this situation, especially given the market has also come off, my number one sector to look at would be the banks. If you look at the banks, the ASPI is down about 11%. But if you look at maybe about 7 or 8 banks or 7 or 8 counters, we've seen banks drop about 18%. If you look at the sector as a whole, that's also down about 10 to 12%. So given that context, valuations look very attractive.
So when you talk about valuations,
Yeah.
if someone is now looking at the banking sector, why is going to be the question to you,
Exactly.
right? And why do you value the bank to be more attractive for the investors is the next questions they would have. So if you can just speak more about it.
So looking at the why, so as you mentioned, I think we've seen rates go up. So when rates go up, what happens is you see banks lending out their new loans at a much higher interest rate. So which means that contributes to your net interest margin. But then it also depends on your book as well, on your deposits, how soon your deposits reprice as well. But then on a general sense, whatever new loan that you give out would be at a higher interest rate. So that would be number one on why banks. And then number two is if you look at the FX spread. So we know we've had a rupee depreciation. But if you look at it historically, before this crisis, the spread between, so if you go to buy dollars or sell dollars in the bank, there's a buying rate and a selling rate. So pre-crisis, the difference between the buy and the sell, so that's basically where the bank makes money, was about 7 rupees a dollar. But right now, this is about 9 rupees to 10 rupees.
So you're saying that the impact also will show in their books.
Exactly.
Now you spoke about the loan, new book on loans, right? But what about new deposits? Now, for an example, there's always a proper negative correlation to the market and interest rates. Now, while they increase their loan book, they'll also need to increase their deposit rates or as per the market rates. Or even if you take the bond yields are also increasing. So you see money moving from equities to debt. Now, do you still feel that spread between lending and deposits will stay the same with the interest rates moving, or will there be a profitability or an advantage to the banking sector?
So that depends on from counter to counter. You need to look at the maturities and also their book growth and also what sort of sectors they're aggressively lending towards as well. So that's I think a conversation for another day probably, because we'll need to break it down by banks.
Right.
But on a general sense, on your new loans that you sort of lend out, you'll have that higher interest rate benefit But then again, like you mentioned, yes, some might not, yes.
And when you say the banking sector, you'll have to look at individual stocks, banks as well, which you feel will need to be looked into. So beyond the banking sector, Sajed, as an investor, what's the next sector would you invest in?
The rupee has depreciated about 10%, about 9 to 10% so far. So if you look at the dollar earning counters, basically export companies which incur costs in rupees. So you export in dollars, you earn in dollars, but you spend in rupees.
Right.
So naturally, let's say last year you sold 100 units for a price of 10 rupees. So this year, primarily or plainly because of the fact your rupee has depreciated, your selling price will be 11 rupees.
Right.
And even if you sell the same amount of goods, you will be a net beneficiary.
Because your top line, and then that will reflect
trickle down to your bottom
line as well.
Exactly.
So what, just not stocks, but you can speak about certain industries.
Exactly.
Which would it be if you're looking at it?
We have, so if you look at our largest within the CSE and within the exporter bucket, you have plantations. So plantations might be quite attractive because it's a rupee cost and then a dollar. But then if you look at certain counters like the garment industry, that has been at risk mainly because of global volatility on the tariff front. So those sectors might be something you would be more conservative or you take a step back on. But then you also have your coconut-based manufactured agri-exports, what we call. So those counters also might look quite attractive within the export segment. Obviously, exports also, just like the banks, you need to be careful with what stocks you pick. But as a sector, yes, this might look quite attractive.
And do you think the tariff has already been contributed, or already investors have valuated, they have valued the company with the tax rate right now, and they have looked at those risks as well?
Well, you could say to some extent, yes, because if you look at certain garment sector shares, or even if you look at certain rubber plantations or rubber manufacturing products companies, you've seen their prices sort of tumble from the pre-tariff eras.
Right.
And we've also seen earnings being very damp in those sectors. So it's tough to say if the impact is, I personally believe to some degree the impact has been absorbed.
Okay.
So, but it's also yet a wait and see, because a couple of days ago, actually last week, we saw the labor tariff come in as the old 10% was expired.
Yeah.
So it's not yet stable on the tariff front.
So you're saying they have taken the risk of an uncertain economic structure or period. So now we spoke about banks, we went to the exports. Now, are you saying, hypothetically, say for the rest of the year, say the conflict is going to remain?
Okay.
You're saying these are two counters that we can ideally look into?
Yeah, so this would sort of turn into a Russia-Ukraine situation then, where the conflict would keep happening, and I'm not saying it would normalize in a very similar manner.
Yeah.
Because that was on the other part of the world.
This is risking shipping routes.
Exactly, freight costs and all of that. But this, at least the two sectors that we discussed so far, are quite insulated to some extent.
Yes. But again, we need to stock pick.
Exactly, within the two
sectors. Yes. So you're saying any other sector would be at a certain risk right now, or?
We do actually have a couple more sectors that would be interesting to look at.
Okay.
Actually, to think about it, if you're an investor who likes to make a bold bet.
Okay. Investors are all of them are bold, Sajid. Now don't.
But let's say you're looking to make a bold bet. A sector that I would look at, or I would recommend an investor to look at, would be the tourism sector.
Interesting.
Right? Because right now, if you look at hotels, in terms of share price, they've taken a beating.
Yeah, and also this is the Q1 would have been also off-peak
seasons. Exactly.
And with the Middle East still being under a non-save category, you're seeing that August, September, where actually we see the numbers gaining, you're saying there could be a
Yes.
Ideally.
And if the tourists do bounce back, and also another factor that we are seeing in terms of arrivals sort of bumping up is the fact that Europe has been experiencing a heat wave, right?
Yes.
So there's a possibility. I'm not saying it's being materialized.
Yeah.
Of more Europeans coming in, and in addition to that, if you look at our composition of tourists, we've seen more Indians come in.
Yes.
So that number has gone from last year, I think it was about 27%, to this year so far, it's about 35% of our arrivals.
That's interesting.
Yeah. So this is also the high spending tourists, because there are people who wanted to maybe travel to Europe but couldn't because of the airfare to connectivity issues.
Right.
So our island is a nice place for them to vacation, I guess.
I think we should do a full year peak season. What we should.
Yeah, exactly.
So you're saying the next 6 months, that is a possibility.
Yes.
And I think also we are at an advantage when the regional travelers can't actually go to the Middle East or Europe because of all what's happening globally. They would try to at least travel to Sri Lanka.
Yeah,
is what you're seeing.
Yeah. And also, in addition to that, once again, going back to the rupee depreciation, hotels are priced in dollars. So you're naturally seeing a 10% bump in your top line, which is easily trickled down. But then obviously you need to factor in the energy costs to food inflation, which has been quite controlled if you look at food inflation.
Yes.
And energy costs is obviously spiking up. But I feel like still, if you are to make a bold bet on this possibility, and if you're looking at an investment horizon of about 9 to 12 months, the tourism sector is a good sector to be in.
To look into.
Yeah.
And that also, so even if you take tourism sector, there are two types that you can look at, right? The city
and the
resorts. And the resorts. So both can ideally benefit from this. Fantastic. Any other sector, or is it these three that?
We also can look at some short-term trading plays.
Okay. That I think everyone will be interested.
Yeah, but
let's start with the.
I think it's so these will be materializing with the June results coming in.
Okay, so you're saying this quarter results that are trickling is something that you're saying we could kind of
bank on.
Okay, so which one do you think is?
So one is, I think, the fertilizer companies.
Oh wow, interesting.
Yeah. So the fertilizer companies, if you look at if you look at urea prices, just after the war, it spiked up.
Yeah.
Went up close to about 70%. And companies which had stock, I'm talking about the companies which had stock, right? And according to our channel checks, most of the listed players had a decent amount of stock.
Fantastic.
So they were able to sell their existing stock at a much higher price.
So you're saying during the turmoil or during that riskier when the war, the conflict actually started, there were no price controls. So these people actually managed to get a higher price.
So what the government does is they have a formula.
Okay.
A pricing formula. Right. Just like we have a fuel pricing formula.
Yeah.
So they give you a price that you can sell it to the government. It's calculated through an import cost plus a couple of other processing costs, whatnot, and then you have a set margin. So if the government decides, okay, this is the import cost, and the set margin, you can sell at that price. Also, what fertilizer players do is, instead of selling the raw urea as it is, they do certain amounts of value additions. So when you do a value addition, there's no formula or there's no price control.
Oh, okay. So that is out of the formula. They don't need to follow the formula to sell once the value addition is given.
Yes. So you might have maybe sold your, let's say, the standard urea product at the normal price even, but if you were able to capitalize on the value added urea, you would have made a killing actually.
So that's the expectation we are hoping to see in this quarter.
Yes.
Or last quarter earnings that are being released right now.
Exactly. Yeah.
Okay.
And also other short-term sectors would be, if you look at leasing companies.
because of the vehicles.
Yes, so it's a very short-term play because we saw a spike in LC openings just before this
tariff, 50%
and then also there was a panic situation because the rupee was depreciating.
Yeah, so and then the loan value was
LTVs
were changed.
So we saw massive LC openings during this phase, and that has stumbled if you look at current numbers.
Yes, exactly. So this earnings, when you see the earnings,
I think we saw a couple of counters come out which had done really well. So that's also another sector which will have a short-term play, but nothing into the medium or the long term.
Only thing is the drag would be on the decisions the government has made in terms of the tax and the LTV, which might still keep those stocks in not as much as we would expect, unless there is something drastic. Some of the counters.
Exactly. We need to wait and see on what the 50% surcharge is going to look like to multiple
other things, which is the new quarter we are living in. So once that is over, fantastic. So we have covered quite a bit. And if you want to give investors one thought in this uncertain global scenario, what would you give them?
So it's important to know your sectors which you should get into, and also certain sectors that you should stay away from. I think that's also something very important to know when you move into the market or when you're in the market, because at one point, if you look at prior to Feb 27, there were a lot of sectors which were attractive at that time.
True.
And now they are not really attractive. So I think we should talk about those also.
100%. So dive into it.
So if you are looking at sectors to stay away from, so if we've seen our energy costs go up. Whether it's fuel to whether it's LP gas. So
basically electricity prices have gone up.
Yes. And so if you are looking at a sector which is energy intensive, or if you look at their cost base, and energy is a very big cost component, you will see margin squeeze,
of course,
in that sector. So those sectors are something you should really stay away from.
Including the interest rate hike, the finance cost, plus this margins are going to be squeezed quite a bit.
As you mentioned, sectors or companies basically with high leverage are also ones you should stay, especially if you have a lot of short-term debt.
So what sector would you call out to stay away from?
So one is the energy intensive sector. So this can include mainly the manufacturing sectors and also to some extent the hotels. But then, as we mentioned previously, there are negating factors. So those are a couple. And then once again, we can also look at now, given that, the energy cost does not only impact listed companies, it also impacts us. You feel it at the pump, you feel it when you have your electricity bill. So that erodes our disposable income. So when our disposable income erodes, there are certain companies which sell discretionary goods, or what we call white goods. So we buy them when we are comfortable with whatever we make. So white goods or discretionary goods are a sector which you would be watchful of. And then obviously vehicle imports, because now the tax structure and also LTV limits. So vehicle importers are also a sector I feel like you should be careful on. And then you have construction.
I was waiting for you to get there. I know that's your favorite sector.
Well, it used to be my favorite sector.
So tell us why. What I exactly, you have told me why this is, but let's tell the investors as well.
So if you look at the construction sector, it was very interesting actually up to maybe Feb 27th. Then only things really went haywire. You had commodity costs really spike, the rupee depreciate, because if you look at our construction sector, materials to contractors, it's heavily import dependent. So commodity prices went up, rupee depreciated, so they got hit on all fronts. So what's really interesting is we've also seen demand slow down because rates have
borrowing cost has increased.
Exactly. So on the retail front, projects which were on the drawing board might take time to materialize.
To finish off. So basically you're saying...
To start off.
Yes.
But then if you look at projects which have progressed about 40%, 60%, they really have no option, right?
Yeah, they have to...
So you have to just go ahead and go ahead with it.
Yeah.
So over the medium term, you might see a slowdown with retail slowing off.
Right.
But then one factor to be mindful about is the government. So we have seen the government, if you look at the past couple of weeks also, they've been giving the green light for so many infrastructure projects. And also...
and using their own money is...
Exactly.
What they're doing,
Yeah. So now, for example, let's say the CEB, let's say they had a planned expansion or they had a planned capex budget for 100 billion. And that was allocated to do 10 projects.
Correct.
But now costs have gone up, so they might only be able to do 7 projects.
Interesting.
But they will spend that 100 billion. So that will trickle down to your material players.
Right.
And also, if you look at, I think the president had mentioned that they're looking at a 2 trillion budget on capex for next year. So if those materialize, you are seeing a push for the construction sector in terms of contractors to materials. They might have a good year depending on
how the government is going to.
Exactly.
But you're saying the more private sectors or private construction sector is what might slow down.
Yes.
But in terms of the materials that are being provided, if you take some of the listed companies which do, they could be benefited if government goes with the planned capex.
Exactly. And also if you look at retail, yes, I understand the conditions are quite unfavorable.
Yeah.
But then again, one thing we need to understand is most of this retail or what we call small scale projects started off last year, maybe mid last year. So they've progressed to some extent. So those need to be completed.
Right.
So they might run up to completion.
Right.
So which means you might not see a surge, but you might still see activity.
Not a growth.
Yes, it might be much less than what you expected
to grow.
Yeah.
Right.
So even when we talk to these companies within this space, what they say is volumes are better year on year.
Yeah.
Certain companies.
Yeah.
But below budget.
Below budgeted.
Yes.
Amount. Okay, so we have seen sectors to look into and sectors to avoid.
Yeah.
Anything else we need to add before we wrap this session up today, Sajed?
So it's always good to have an idea on the sectors to what you should get in, what you should get out. Also, the most important part is picking your share within the sector. Because that's the real game that you need to play. If you are an investor, you need to be mindful.
No, don't say it's a game.
Yes.
The strategy.
Strategy, exactly.
So Sajed, we know what to focus on, the sectors to avoid. And what else do you think investors need to prioritize?
It's good knowing your sectors that you should stay in and also sectors that you should stay away from. But if you are to have a proper strategy, it's also important to know which shares should you be in, which companies should you be in, and which companies should you stay away from. So stock picking is another exercise that would sort of help you be ahead of the curve in terms of investing.
Right.
And that would actually be key to this.
Absolutely.
Fantastic.
So guys, we have things to focus on. We have sectors to avoid. And I think, as Sajid said, with the global geopolitical uncertainties, picking your stock is one thing, but I think being alert to what's happening and changing your strategy accordingly is going to be very important. Thank you, Sajid. So guys, stay tuned for more episodes from Under the Hood from CAP.